Hello, my name is Kerry Zivkovich, and today I'm presenting my strategic analysis of Dow Chemical's Industrial Intermediates and Infrastructure Division, what we like to call II&I for short. This presentation is for my Strategic Knowledge Integration course at Robert Morris University. Before we get started, I'd like to say that I work for Pressure Chemical Company, a small private chemical manufacturing company right here in the city of Pittsburgh. Had Pressure Chemical been a publicly traded company, I would have likely done this assignment on them. But as we are, I've settled on one of our customers instead. Dow and their II&I division most closely resemble Pressure Chemical. So let's learn more about them. So moving forward with this presentation, we start with an overview of Dow and II&I, touching on some strengths and weaknesses, both external and internal, on our way to the main purpose of this presentation. We have identified a specific challenge facing Dow, and we propose a recommendation to address the issue, before discussing how to implement the plan and what the expected outcomes are. So let's get started. Dow is a powerhouse of a chemical company worth $5.5 trillion. They were founded in 1897, and today they operate in 160 countries worldwide. They control 104 manufacturing plants across 31 different countries. As shown in the chart below here, Dow generates 62% of its revenue internationally, while North America remains its largest market with 38% of sales. The region of Europe, Middle East, Africa, and India are closing the gap with 33% of their own. One of three separate divisions, II&I brought in $11.9 billion in 2024 sales. They specialize in polyurethanes for construction and automotive industries. Dow's mission is to deliver sustainable future through material science expertise in collaboration with their partners. From my experience at Pressure Chemical Company, where we work as scale-up partners for Dow and all of their R&D projects, I see how this plays out in the real world. Let's take a look now at the external environment. The chemical industry is oligopolistic. This means that there are very few companies dominating the market. I find the industry to be moderately attractive as it's growing at a 3.5% rate, and that's largely driven by eco demand. II&I faces some tough rivals, like BASF, making $102 billion revenue, LyondellBasell at $41 billion, and Covestro at $19.6 billion. Key market forces affecting this industry include sustainability mandates like the EU Green Deal, fluctuating oil prices, digitization, and post-COVID supply chain disruptions. As you can see in Porter's 5 forces chart below, we rate new entrants low due to the billion-dollar barriers to entry. Supply power is high due to volatile feedstocks. Rivalry is intense with likely price wars, and substitutes are considered moderate as there are bio-alternatives to most of the products they make. These pressures demand innovation, which Dow is pretty successful at meeting, but at what cost? Next up, let's look at the internal environment. II&I shines with a 10% return on invested capital, which is 2% above their rivals. This is fueled largely by a $20 billion Sedera joint venture that enables a steady supply of incoming materials. Return on investment capital is impressive, but more so when you consider that Dow invests $1 billion annually into R&D, yielding over 500 green patents alone. In the competitive profile matrix that you see below, II&I scores a 3.65 out of 4, edging out top rival BASF, who scored a 3.5. Some of the key markers here were sustainability, supply agility, and AI use. They do this by employing a differentiation strategy, focusing on premium eco products like low carbon plastics, allowing for a 5% price premium. But despite these impressive strengths that position II&I ahead of its rivals, there's one major weakness that seems to drag everything down, and we'll discuss more of that on the next slide. Critical strategic issue. Now, the core problem, as I see it, is while Dow scored well in logistics agility, that was fueled largely by incoming supply. Outgoing logistics, on the other hand, is a completely different story. The issue, as I see it, is siloed logistics across Dow's three divisions: II&I, packaging, and performance materials. And despite an integrated supply chain group, these divisions operate completely independently from one another. While being independent can be good for innovation, it is leading to supply chain inefficiencies. Some examples are half-empty ships, delays, and missed discounts. This is an issue that costs Dow $1 billion annually. That's 15% of their total logistics spend for a year, including $591 million in Q2 of 2025 alone. In the EMEAI region, for instance, 20% of shipments are late or incomplete. This erodes customer trust, and studies show that since 2020, 95% of chemical product failures tie back to supply chain issues. And unfortunately, it doesn't end there. This issue also inflates Dow's Scope 3 emissions by 10 to 15%. This clashes with Dow's path to zero goals and its mission to protect our planet. At PCC, I felt these disruptions personally. Delays in materials coming from Dow disrupt our operations and have many ripple effects downstream. This isn't just financial, it undermines sustainability and collaboration, contradicting Dow's core mission. So, with such a big problem, how might we go about fixing it? I recommend a two-phase approach that starts with proof. Phase one is a $5 million, 6-month data study to quantify the losses. Led by President Marco Ten Brugate alongside logistics specialist McKinsey working as consultants, Phase 1 will deploy radio frequency identification tags across the entire company to use Dow's Microsoft 365 Copilot program to track volumes, routes, delays, all in real time. By Q3 of 2026, we will validate $100 to $200 million in saving opportunities, like underutilized capacity in EMEAI routes. This builds buy-in and uses existing tech to avoid blind investment from the board. To a much lesser extent, I've done this at PCC. By using technology, I've been able to see what we buy, who we buy it from, and where there are available cost-saving opportunities. Sometimes it's as simple as buying paper plates from Sam's Club instead of WB Mason. That can help save the company money. With Dow, it's just bigger. On to phase two, an AI-driven logistics platform. Phase two builds on phase one. It's a $50 million AI-driven platform integrating all of Dow's divisions, plants, and shipments worldwide. Think of UPS for a moment. You input your package details, and the system optimizes the route instantly. Here, this new platform will link all shipments worldwide. When scheduling a shipment, coordinator at II&I will see a suggestion to combine shipments with packaging, like merging a polyurethane shipment from II&I with a film shipment from packaging into one larger shipment going from Sedera to China. There may be an option to get it where it needs to be as fast as possible. That option is going to cost more money. The platform is there to tie Dow's massive chemical company back together. Implementation considerations. A big part of the issue here is the lack of coordination between the three divisions. Implementation of this plan is going to need a lot of structure. COO Karen Carter and Marco Ten Brugate, as well as the other presidents, will oversee the execution of improving the coordination of Dow. Phase 1 rolls out the RFID technology in Q1 of 2026. McKinsey reports its findings by Q3. Phase 2 launches the AI Hub by early 2027, integrating with Copilot. Some challenges we expect to see include divisional resistance and hesitancy from the board due to the $55 million price tag. We can mitigate these issues with data from phase one, proving this program's ROI and tying it to sustainability goals and the company's mission. Our timeline expects savings to kick in by the end of 2027 and positioning Dow to be stronger than ever. Some more on those expected outcomes. We expect to see $50 to $100 million in savings per year, enhancing outgoing reliability by 10 to 15% and emission cuts of 10 to 15% as well. All of these things boost customer trust and return on investment capital. As this graph shows, the plan hits on cost, sustainability, and reliability, fully aligning with Dow's mission. For II&I, this means backing up the talk about its green initiatives with some real action. In conclusion, II&I's strengths, like its 10% return on investment capital and $1 billion in R&D spending a year, are very real, but siloed logistics cost them $1 billion a year and contradict their very own mission. My two-phase plan, the data study and the AI platform, saves Dow $50 to $100 million, cuts delays and emissions by 10 to 15%, ensuring sustainability leadership. Dow must act now if it wants to live up to its mission. Thank you for your time. I'm Kerry Zivkovich, and this has been a strategic analysis of Dow Chemical. Thank you.